GM. Get my mic set up. GM, 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 GM. Today is Friday? Thursday. Friday? It's Friday, isn't it? Fucking hell. Christmas week, things get a bit crazy. So it is Friday. It is the 22nd of December. And the dollar's nuking. Christmas come early for dollar bears. All these dollar bulls have been eating their words all year, really, as the dollar just goes nowhere. So dollar down is good for risk assets generally. And this isn't like, just a healthy pullback before trend continuation. This is more likely weakness, right? It's not behaving like an asset that wants to trend upwards. If it was, then it would have pulled back, swept that out, pushed higher, broken out, and continued to trend. And even pulling back in here, maybe pull back to there and then back up. The dollar has no reason to trend because obviously the Fed have signaled that printer is coming, and that alone won't make it weak because, of course, the DXY is just a measure of the dollar against the euro and the pound and the yen and everything, which are also shit coins. But I think in particular the yen is going to strengthen, from my limited forex understanding. The macro people that I listen to say that the Japanese yen is set to be particularly strong. So that's probably a big part of why the dollar is going to underperform, because certainly the euro is no fucking the euro is a proper shitcoin. But anyway, all that matters is demand for dollars is low. Demand for scarce assets is rising. Gold is looking fucking amazing. After its quick false breakout, came back down. Very, very, very strong reaction. Daily, this is the perfect false breakout pattern. False breakout comes back to the 50 EMA, holds. Perfect. Silver, strong as well. Silver's been in a really, it's just been a really long consolidation. But if and when it can actually break out of this, which is trying its best to do, silver's going to rip as well. And of course, that means our old friend Bitcoin should do well. Bitcoin has already been just smashing everything to pieces all year, so it doesn't mean that Bitcoin has to. It doesn't mean Bitcoin has to pump now because they're pumping. It has its own things going on. It's more the general trend. So the general trend of the market, if it is for metals to break out, gold especially, that's going to signal a really good year for Bitcoin. So I think you want to keep a really close eye on that. That's very, very important. You want to look at the dollar, silver, gold, and just remember that everything is a trade against the dollar. Right? It's a global reserve currency, so every asset you own, you have a decision of whether you want dollars or that. Right? You want a Rolex watch, you have to decide, would you rather have the 30 grand cash or the Rolex watch? And assuming you're not buying the watch to tell the time, your decision is made on which you think is stronger. If you think that the dollar is being devalued and you want to buy things that are scarce and have perceived value, you'll buy a watch, a Rolex, because you think that it's going to hold its value or increase in value. Right? Same as really anything scarce. This way people buy art. Well, mostly buy art for money laundering, but that's for another day. They'll tell you they buy rare art because it's scarce and it holds its value. Property, and of course silver, gold, and Bitcoin. And Now, crypto, like I've been ranting for a couple of weeks. I think crypto as a whole is now becoming, our version of, like when I say our, I just mean like the younger generation, Gen Z, millennials. And of course, there's plenty of people who are in Gen X or even boomers that are into crypto. But as a rule, as a looking forward to the future generations, uh, crypto's our thing, right? And so if you keep seeing gold, silver strong, dollar weak, Bitcoin strong, you want to own altcoins, right? Obviously, Bitcoin or altcoins. But when you're seeing more of this anything but fiat trade, which is really what we should call it, where you start to see basically every asset trending up that isn't fiat cash, that's again the market telling you that we understand what the Fed's going to do, the government's going to do, and you need to own anything that is not cash. So I actually think that we might have a shorter cycle. To me, it doesn't really matter. Because like I said on yesterday's daily lesson, I don't think we have cycles anymore in the way we imagine them. Because the last few have been totally Fed driven, right? I know people say, like, there was two things. There's rates, right? And there's the global liquidity. And really, when you look at it, it's pretty hard to deny that it has all been Fed driven, even since 2018. We all know that COVID and the response to that was all Fed driven and printing money and all that. But actually, I'll just leave it on line chart. When you look at this, it's even more obvious. Go to weekly, zoom out. It wasn't just the halving or whatever in 2018, 2017, and it wasn't the halving in 2020, right? It's not enough. The halving is not enough to give a total up only bull run, right? The halving helps, but it also helps when global net liquidity bottoms out in December 2015, and then right as we go into the halving, liquidity is rising, and then as we rally out of the halving, liquidity keeps rising. Sorry, you get the Bitcoin chart up here. We have rates dropping, I should say, which is the other thing. Right, there we go. Right, that as Bitcoin's rising, candles, global liquidity is rising, makes sense, and rates are dropping. So the orange line, which I'll make blue because I've got two orange lines, the blue line is the US 10-year Treasury yield, and the simple calculation is if this is going down, risk assets will go up. Falling rates indicates the market not expecting the Fed is going to keep restrictive monetary policy. Because if rates are lower, obviously, that means the Fed funds rate, which is the rate they set, must eventually be lower. And so this often leads what the Fed does, which is why you'll see it now in a sec when I go back, that it's at like 4% or whatever, even though the Fed funds rate is still technically at 5.5%. The market's calling bullshit, saying, we know you're going to cut. You can't fool us. So we had falling rates and rising liquidity in 2016, and into 2017. And then we had, it's hard to keep all these fucking together. We had falling rates all the way from the peak, right? So the Fed's most aggressive, or the markets most aggressively pricing in rate hikes, and interest rates were rising, or yields were rising, sorry, in 2017-18 as Bitcoin dropped off, because there's more demand for dollars when rates are rising, when yields are rising. There should be more demand for dollars and less demand for risk assets. Then peaks out in late 18, goes on a one-way decline all the way to COVID. At the same time, crypto recovers, right? Puts in a higher low, even with the COVID crash. And at the same time, liquidity, which was sideways basically from the peak of the bull, right? Liquidity peaked out just a few months after and then started to decline. Liquidity started getting pumped back in again by the Fed, or by everyone, all the central banks, because of COVID, right? And so then all the way through 2020 and 2021, you had rising expectations of rates. So rates were rising all the way. But that's fine to a certain extent, until the Fed started saying, we're going to raise rates ourselves. Right? So this was just sort of a mean reversion back to where it was on the blue 10-year. Then it started to really break out and push all the way up. And you can see how destructive the combination of falling global liquidity and rapidly rising bond yields, rates, is for risk assets. Down 80%, 70%, altcoins down 90%. Global liquidity then started to kind of flatten, right? Not exactly making new highs yet, but Bitcoin caught a bid. So I think a lot of this is the expectation now that BTC is going to be bigger than it is, and it's going to be this, safe haven asset and best form of collateral and digital gold and all that. So, and also the market, especially with the big drop off in rates in the 10-year rate here, 10-year yield, where it's at 3.8% now. As that trends lower and lower and lower,